Let me tell you about a man named Gerald. Gerald spent 38 years working in logistics management out of Columbus, Ohio. Methodical guy. The kind of man who keeps a spreadsheet for his grocery budget and changes his oil every 3,000 miles, not 3,500. Gerald did not gamble on crypto. He did not chase hot stocks. He did not panic sell in 2008 when half his colleagues were calling their brokers at midnight. He just saved, quietly, consistently, year after year. By the time Gerald turned 73, he had $1.1 million sitting in his traditional IRA and 401k combined. He felt secure. He felt honestly proud. 4 decades of discipline sitting right there in black and white on his account statement. What Gerald did not know, what nobody in his entire professional life had ever sat him down and explained, was that the IRS had been watching that account grow for 38 years with enormous patience. Because the IRS does not need to rush. They wrote a rule into the tax code that guarantees them access to your retirement savings at the exact moment in your life when you have the least flexibility to fight back. And that rule has a name. It is called the Required Minimum Distribution, the RMD. And the moment Gerald turned 73, it activated. Not like a warning, not like a nudge, like a bill. A mandatory, federally enforced, mathematically calculated bill that shows up every single December 31st for the rest of your life and gets larger every year. Gerald's first RMD on a $1.1 million balance came out to roughly $41,500. Forced out of his account, forced onto his tax return as ordinary income, not capital gains, not qualified dividends, ordinary income, stacked directly on top of his pension, his Social Security, his CD interest. His effective tax hit that first year was over $17,000. He kept less than half of what the government made him withdraw. And here is the part that should make you stop and reread that sentence. He did not choose to take that money out. He was required to, by law. With a 25% excise penalty waiting if he missed the deadline by even a single day. This is what the financial industry does not advertise. This is what the glossy quarterly statements never mention. The traditional IRA and 401k are not retirement savings vehicles. They are deferred tax collection vehicles, and the IRS is the silent partner who never once contributed a dollar, but will collect on every single one you put in. Today I am going to walk you through the 5 specific account types that create this problem, and more importantly, what you need to do about each one before your 73rd birthday, while you still have time to act on your own terms instead of the IRS's. This is not abstract. This is math. Let's do it. First, understand the mechanics of what you're actually dealing with. The RMD calculation is simple and ruthless. The IRS publishes a table called the Uniform Lifetime Table. It assigns a divisor to every age. At 73, that divisor is 26.5. You take your total pre-tax retirement account balance as of December 31st of the prior year, divide it by 26.5, and that number is your mandatory withdrawal for the year. On a $1 million balance, that's $37,736. On $1.5 million, it's over $56,000. You cannot negotiate it. You cannot delay it. You cannot choose to reinvest it instead. And here is what makes it structurally vicious. The divisor shrinks every year. 26.5 at 73, 25.5 at 74, 24.6 at 75. Meaning the percentage of your account the IRS forces out gets larger every single birthday, like a leak in a boat that widens as you try to bail. But the raw withdrawal amount is only the beginning. The real damage happens in 3 layers stacking simultaneously. Layer 1 is the income bracket spike. Most retirees before RMDs believe they are sitting comfortably in the 12% federal bracket. Pension income, Social Security, maybe some interest. Manageable. Then the RMD lands and pushes them into the 22% or 24% bracket on the overage. Layer 2 is the Social Security taxation trap. Here is something the financial press treats like a footnote, but should be a front-page story every single year. The thresholds that determine how much of your Social Security gets taxed were set in 1983 and 1993. They have never, not once in over 4 decades, been adjusted for inflation. So as your income rises with RMDs, more and more of your Social Security benefit becomes taxable. Above $44,000 of combined income for a married couple, up to 85% of your Social Security check is suddenly ordinary income. Income that was not taxed the day before your birthday. Layer 3 is IRMAA, the Medicare Income-Related Monthly Adjustment Amount. This is the premium surcharge that hits retirees whose income crosses certain thresholds. And unlike a graduated tax, IRMAA operates on a cliff. You go $1 over the line and your Medicare Part B and Part D premiums for the entire following year jump, sometimes by thousands of dollars. No ramp, no proration, binary. All three of these hit simultaneously the moment that RMD pushes your income past the thresholds. The result is that a retiree who withdraws $37,000 in forced distributions might realistically keep $20,000 of it after federal tax, state tax, newly exposed Social Security taxation, and IRMAA surcharges. You are not keeping your money. You are keeping what remains after the IRS, your state, and Medicare are all done with it. Now let's talk about the 5 accounts and what to actually do. Account number 1. The traditional 401k. This is the primary source of the problem for most people. The pre-tax 401k is the account the brokerage industry spent 45 years convincing you to maximize. And they were not wrong that it reduced your taxes today. What they did not volunteer is that every dollar of tax you deferred is a dollar the government will collect later, at whatever rate applies then, with interest baked in because the balance has been compounding. Here is the brutal arithmetic. You defer $20,000 at age 35 in the 22% bracket. You save $4,400 in taxes that year. That $20,000 grows for 38 years to roughly $190,000. At 73, the RMD pulls it out at an effective rate somewhere between 30 and 40% when you account for the stacking effects. The IRS collects $57,000 to $76,000 on the back end. You saved $4,400 on the front end. The solution, and this requires action years before 73, is the Roth conversion ladder. The window between when you retire and when RMDs begin, typically somewhere between age 62 and 73, is the single most valuable tax planning window of your financial life. During this period, you have lower income, control over withdrawals, and time. You use that window to systematically convert chunks of your traditional 401k into a Roth IRA, paying tax now at known rates on known amounts, and moving that money into a vehicle that will never have an RMD, never generate taxable income, and never trigger Social Security taxation or IRMAA cliffs. The conversion amounts need to be calibrated to your bracket. Most planners target $40,000 to $80,000 per year, filling up the 12% and 22% brackets without spilling into 24%. Your state of residence matters significantly here. A retiree in Florida or Texas with no state income tax can run this more aggressively than one in California or New York. Account number 2, the rollover IRA. This is the account most people forget they have because it was built invisibly across decades of job changes. You left a company in 1994 and rolled the 401k into an IRA. You left another in 2005 and did the same, a third time in 2016. Now you have a $650,000 rollover IRA at a brokerage you barely check. Every dollar in that account is pre-tax. Every dollar will hit your tax return as ordinary income when distributed. And the IRS aggregates all your traditional IRA balances for RMD calculation purposes. They do not care that the accounts came from different employers. They sum them. The additional complication here is something called the pro rata rule. If you have any pre-tax money sitting in a traditional IRA and you attempt a backdoor Roth conversion, the IRS does not allow you to cherry-pick the after-tax basis. They treat the conversion proportionally across all your IRA balances. The solution in many cases is to either fully convert the rollover IRA during your harvest years, drain it systematically, or roll it back into an active employer 401k plan, which removes it from the pro rata calculation entirely. Account number 3, the inherited IRA. This is where the Secure Act of 2019 introduced what I consider one of the most punishing and least discussed changes in retirement tax law of the last generation. Before 2020, if you inherited an IRA from a non-spouse, typically a parent, you could stretch the distributions over your own life expectancy. Gradual, tax-efficient, manageable. The Secure Act ended the stretch. Non-spousal beneficiaries who inherit from someone who died on or after January 1, 2020 must fully drain the inherited IRA within 10 years of the original owner's death. And if the original owner had already started taking RMDs, finalized IRS rules from 2024 require you to also take annual minimum distributions during years 1 through 9 of that 10-year window. What this means practically is that many people in their 50s and 60s are sitting on inherited IRAs they are doing nothing with, assuming they have time, not realizing they are compressing a significant tax event into an increasingly short window. The strategy is front-loading. Take larger distributions from the inherited IRA in your lowest income years. If you are not yet collecting Social Security, if you are between jobs, if you have room in the lower brackets, take the money then, at known rates, rather than allowing it to stack on top of your own RMDs, your own Social Security, and your own pension income in later years. A lump distribution in year 10 of a $400,000 inherited IRA is a near-certain tax catastrophe. Spreading it across earlier, lower-income years is not. Account number 4. The variable annuity inside a qualified account. This one is less common than the others, but represents a specific kind of damage that is worth naming directly. A variable annuity is an insurance product whose central selling point is tax deferral. Growth inside the annuity wrapper is not taxed annually. That is the feature. That is why someone might choose one. The problem is that a significant number of retirees ended up with variable annuities sitting inside their IRA or 401k, accounts that already provide tax deferral under the tax code. Wrapping a tax-deferred product inside a tax-deferred account gives you no additional tax benefit. You are paying for a feature you already own, and the cost of that redundancy is not trivial. Variable annuities typically carry mortality and expense charges, sub-account fees, and rider fees that combined often run 2.5% to 3.5% annually. On a $200,000 position that is $5,000 to $7,000 per year in drag, against a backdrop where total return on a comparable index fund might be 7% to 8%. The strategy is to evaluate the surrender schedule. Most variable annuities carry declining surrender charges, typically 7% in year 1, declining by 1% per year. If you are already past the surrender period, the exit is clean. If you are within it, you need to calculate whether the remaining fee drag exceeds the surrender penalty. In many cases it does, and exiting early is the mathematically correct decision. The proceeds go back into a low-cost index fund inside the IRA. Account number 5. High-yield CDs in a taxable account. This is the one that surprises people most because CDs feel like the responsible, conservative choice. Here is the problem. CD interest is reported on a 1099-INT as ordinary income every year. Every dollar of interest you earn on a taxable CD goes directly onto your tax return and into the calculation that determines your Social Security taxation threshold and your IRMAA bracket. Pre-RMD, this may be tolerable. Post-RMD, when $37,000 or more of forced distributions is already stacking onto your return, that CD interest is not being taxed at some moderate rate in isolation. It is being taxed at your highest marginal rate, and it is actively contributing to Social Security taxation and IRMAA surcharges. A 4.5% CD in this environment may have an effective after-tax, after IRMA, after Social Security cascade yield closer to 2.2% or 2.4%. You are earning less than half of what the advertised rate suggests. The restructuring options before RMDs begin include shifting taxable interest-bearing assets into municipal bonds, whose interest is federally tax-free and excluded from provisional income calculations. Treasury I bonds and EE bonds, where interest can be deferred until redemption. Short-duration Treasury ETFs, held inside a tax-advantaged account rather than taxable. Or equity index funds in taxable accounts, whose returns come primarily through unrealized capital appreciation rather than annual taxable distributions. The goal is to reduce the amount of ordinary income hitting your return before the RMD machine arrives and makes every marginal dollar more expensive. Here is where all of this connects. None of these are separate problems. They are 5 components of a single coordinated tax exposure that detonates at age 73 if nothing is done. The traditional 401k feeds the RMD. The RMD spikes the bracket exposes the Social Security and CD interest push you over the IRMAA cliff. The inherited IRA adds a forced distribution on top of that. The variable annuity bleeds you with fees while you wait. The window to address all of this is the years between retirement and 73. Those are your harvest years. Low income, bracket room, time to convert, restructure, and reposition before the mandatory machinery starts. If you are 60 today, you have roughly 13 years. If you are 65, you have about 8. If you are 70, you have 3. If you are 72, you have months, not years, before the first RMD is legally required. The Roth conversion you execute in 2026 must be completed by December 31st of this calendar year to count for this tax year. Not next week, not in January. The IRS is not hostile. It is simply indifferent to whether you planned or not. The math runs the same either way. The 5 accounts, the 5 strategies, the window that exists right now. This is the framework. Get the plan in front of a CPA who specializes in retirement distribution planning, not one who simply files your return and asks if you have any questions. The distinction matters enormously. If you found this useful, drop in the comments which of these 5 accounts represents your largest exposure and whether you have started conversion planning yet. I read every one.